Let us see the next question. XYZ Incorporation issues 10 million pound floating rate loan on 1st of July 2013 with resetting of the coupon rate every 6 months equal to LIBOR plus 50 basis points, that is plus 0.5 percentage. XYZ is interested in new point for us collar strategy by selling floor and buying a cap. XYZ buys 3 years cap and sells 3 years floor as per the following details on July 1st, 2013. Notional principal is 10 million. Friends, over here we will consider the currency pound only. That is the currency which they have provided over here. The reference rate is 6 months LIBOR, that is the floating rate of interest. Strike rate is 4% for floor and 7% for cap. The amount of the premium is 0. Since the premium paid for the cap is equal to the premium received for the floor. Using the following data, you are required to determine the first question. Effective interest paid out at each date. The average overall effective rate of interest on per annum basis. Reset dates have been given to us. 31st of December 2013, 14, 15 and 30th of June 2016. LIBOR rates have been given to us. Everybody is requested to go through the question. Do not solve it, just go through it. That is a new point in the question. Now friends, we are going to have understanding of a new point over here, and it is given a name as collar strategy. Now how does the collar strategy work? Let us understand. We understand that over here the question is providing the information. A company is issuing floating rate loan. It means that it is raising the funds by way of the floating rate of interest. It is a kind of borrowing of the funds. Borrowing is made at the floating rate of interest. Basically, to cover up the increase in the interest rate, we purchase the cap option. So over here you purchase the cap option as what you do usually. At the same time, you do not want to incur the cost of the premium for purchasing the cap. So what you do in order to cover up the cost of increase in the rate of interest, what happens at simultaneously you sell floor so that you will be able to save the premium. So basically over here what happens at you sell floor, you will receive the premium and that premium will be paid for purchasing the cap. That is the reason over here the premium amount is given 0. Since the premium paid for the cap is equal to the premium received for LIBOR. This is what you are doing. So basically you have purchased option, at the same time you are sold option. These are the two things that you have done. And when you are doing combination of the cap and floor, it is given a technical name as the collar strategy. This is what's the introduction of the concept which we are going to understand in this example. Understanding further, that's over here, how it will work. As far as the strike rate is concerned, it is 7% for cap. We have been provided with the information about the LIBOR. In that it is 6, 7, 5, 3.75, 3.25 and 4.25. So in none of the cases, the LIBOR rate of interest has exceeded 7%. So we are not going to receive anything. This is what we understand. Floor is 4%. So we have given right to somebody, and because of that, what happens, let's say, whenever the rate of interest is falling below 4%, at that time we have to pay. So we are required to make the payment when the rate of interest is 3.75%, and we have to pay when the rate of interest is 3.25%. So over here, say you are required to make the payment for 2 times when the rate of interest is, say, below 4%. Dear students, over here in this question, I make an assumption that, say, this 4% is required to be compared directly with this LIBOR. If at all you make an assumption that, say, this 4% is required to be compared with LIBOR plus 0.5, then in that case what will happen? Over here nothing will come. Why? Because 3.75 plus 0.5, 4.25 is, say, exceeding 4, so you don't have to pay. And over here you are required to make the payment only 0.25%. However, we are making an assumption that, say, LIBOR is directly required to be compared. If you make assumption otherwise, is also acceptable from examination point of view. So friends, over here logically we understand that, say, we will be having, say, the cost in a specific range. In case of the cap transaction, what will happen? So your cost will not go beyond a point, and it will always fall down if at all the floating rate of interest substantially reduces. In case of the collar strategy, what will happen? Say your cost will not increase beyond a point. Why? Because you have purchased a that is the cap option. At the same time, it will not fall down substantially. Why? Because you have sold floor. So what happens that, say, when the rate of interest is falling down substantially, you are required to make payment. But of course, nothing is free and nothing is, say, going to be like the always loss making. As you are selling the floor, you are able to receive some amount of the premium, and usually that amount of the premium is to offset the amount of the premium that you have to pay to purchase a call option. That is the cap option. So here we understand that, say, we have to pay for 2 times. Suppose by chance this rate of interest would have been, for example, 4.5%, for example. Then in that case we would have received in all these cases. Why? Because the LIBOR rate of interest is exceeding 4.5. So whenever the floating rate of interest is exceeding 4.5, you would receive something. This is what we understand. So first of all, I am dictating a note to you, and then we will execute the answer. Heading right down, collar strategy. In that, write down first point. It is a strategy in which there is a combination of cap and floor. Second point, in case of borrowing, comma, cap will be purchased and floor will be sold. And vice versa. Third point, we can compare LIBOR plus 0.5 with strike rate to calculate interest payable slash receivable. Full stop. Otherwise, we can compare floating rate of interest directly with actual interest. Otherwise, we can compare floating rate of interest with actual rate of interest. Fourth point, we will receive, comma, if floating rate of interest exceeds 7% and we have to pay if floating rate of interest reduces below 4%. Hence, cost of borrowing will remain in a range. Full stop. Now write down heading. Working note number 1, calculation of number of days. Now friends, over here C Institute has given suggested answer wherein they have computed exact number of days. So the date of borrowing is provided to us as 1st of July to 30th of June. Sorry, 1st of July to 30th of December. Number of days 1st of July to 31st of December, year 2013. So July, August, September, October, November and December. 31, 31, 30, 31, 30 and 31 once again. That comes to 184 number of days. And 1st of January to 30th of June will be 181 number of days. That is the balancing figure. Because over here language of the question is very clear. Let's say we are required to make the computation of the interest paid at each reset period. Effective interest paid means we are required to take into account the amount that we are going to receive due to cap purchase, amount of the interest that we have to pay because of the floor sale, and with that we are required to find the effective interest. And as I told you that we will make a comparison of directly the floating rate of interest with 4%. That is the reason, say, in these two circumstances, in this two situation, we have to pay. Otherwise, if at all you make a comparison as LIBOR plus 0.5 with 4%, then in that case, only in this situation we would have paid. So this is only a small explanation for your understanding. This is the first thing. The second thing that we understand that's over here, when you compute the number of days for the year 2016, which is leap year, you have to be careful that you will take 182 number of days instead of 181 number of days. Okay. And coincidentally, in case of the cap, we don't receive anything. Otherwise, we may be provided with the information wherein we are going to receive something. Right on heading calculation of interest payment for each reset period. Column number 1 is date. Column number 2 is interest payment. Then there may be cap payment, but it is not there. So cap receipt. It is not there, so it is floor payment, and that is where the effective cost is there. So here it is starting date is 31st of December 2013. The amount of the borrowing is 10 million. That comes to 100 lakhs. Dear students, it has been given that the reset period is like 6 months. It means that after every 6 months, the floating rate of interest is going to be declared. So 100 lakhs into 6.5%. Okay. You have to pay interest at LIBOR plus 0.5%. Into number of days is 184. So to 184 divided by 365. This is the way we are required to show the interest payment for the first 6 months. So 100 lakhs into 6.5% into 184 divided by 365. So that comes to 3,27,671. This is the interest payment. No floor payment is there, and coincidentally there is no cap received. So this is the final cost, 327,671. Friends, for these kind of questions, I always believe that not only your concept should be clear for the purpose of doing answer, but at the same time you should be having a writing practice for doing these answers. Because unless you have the writing practice in examination, you will not have that flow of doing answer. So make sure that you are not only clear with the concept, you have the writing practice also of doing answer. Doing only audit of the answers will not be sufficient. You are required to execute, you are required to do answer for the purpose of, say, having confidence from examination point of view. Now let us see the next one. The rate of interest is 7, so plus 0.5, it comes to 7.5%. So 100 lakhs into 7.5% into, this time it is 181 divided by 365. So 100 lakhs into 7.5% into 181 divided by 365. So 3,71,918. Then 31st of December 2014, In that 100 lakhs into 5.5 percentage into 184 divided by 365. So the answer would be 100 into 1 lakh into 5.5% into 184 divided by 365. So 2,77,261. Next, 30th of June 15, then in that case it is 100 lakhs into 3.75 plus 0.5, that is 4.25 percentage into 181 divided by 365. So the answer is 2,10,753. For 31st of December 2015, it is 3.75%. Now 31st of December 2015, in that 100 lakhs into rate of interest is 3.25 plus 0.5, that is 3.75 percentage into 184 divided by 365. It comes to 1,89,041. Next, 100 lakhs into 4.25 plus 0.5, that is 4.75 percentage into, importantly, 182, because of the leap year. Not a conceptual point, just be careful. So 100 lakhs into 4.75% into 182 divided by 365. So 2,36,849. That is the interest that we have to pay. These are the interest payment actually to the bank. Now friends, over here we are assuming that this 7% of the cap rate of interest is required to be compared with directly this. And every time the rate of interest is 7% or less than that, so we are not going to have any receipt. If at all you make a comparison, of that 7% rate of interest with this, if that is total interest, 6.5, 7.5, 5.5, 4.25, 3.75, 4.75, then in that case we understand that in this situation you are going to receive something. In this situation, when the rate of interest is 7.5, which is exceeding 7, this is the way we are required to give the effect of the interest rate cap. I am making a comparison directly with the floating, so we are not going to receive anything. In terms of the payment, this 4% is compared with the directly floating rate. So in this two situation we have to pay. Again, only for understanding, suppose you make a comparison with the total, then in that case 6.5 is not less than 4, 7.5 is not less than 4, 5.5 is not less than 4, 4.25 is not less than 4, 3.75 is less than 4. So only in this one situation you would have paid, and 4.75 is not less than 4. But since we make that assumption, So we are going to make the payment over here in this situation, and we are going to make payment in this situation. So the heading is the floor payment. So over here there will be floor payment, that is 30th of June 2015. It is 100 lakhs into 4 minus 3.75 into 181 divided by 365. Then 31st of December 2015, again you have to pay. So what will happen? It is 100 lakhs into 4 minus 3.25 into 184 divided by 365. So these are the two dates on which you have to pay. 100 lakhs into 0.25 percentage into 181 divided by 365. So we have to pay 12,397. Then again 100 lakhs into 0.75 percentage into 184 divided by 365. So 37,808. That we have to pay. So now the effective cost will be calculated. Over here it will be 3,71,918, 2,77,261, 2,10,753 plus 12,397. So 2,23,150, 1,89,041 plus 37,808. So 2,26,849. And for the last one it is 2,36,849. So this is the way we will make the computation of the total cost. It will be 3,27,671 plus 371,918 plus 2,77,261 plus 2,23,150 plus 2,26,849 plus 2,36,849, and the total cost comes to 16,63,698. This is the total cost. So let on now further answer. The further question says that calculate the average overall effective rate of interest per annum. That is a question. So let us answer second question. Calculation of average overall effective rate per annum. In that, I is equal to PRN upon 100. This is a simple formula. Interest is calculated by us 16,63,698. Principal, that is an amount of 100 lakhs. R is the rate of interest which we are required to compute. N is the number of days. So 365 into 3 plus 1, that is 1096 divided by 365. So over here 1096 is calculated as 365 days in a year into 3, that is 3 years, plus 1, that is of 29th of February. So now R is found as balancing figure 16,63,698 divided by 100 lakhs into 365 divided by 1096 into 100 for getting answer in percentage term. This is the way we can find answer. 16,63,698 into 365 into 100 upon 100 lakhs upon 1096. So that comes to 5.5406%. This is the way we can compute the answer. So friends, this is what the effective rate of interest on the per annum basis for the borrowing of the funds on annual basis.